Well, as we've been hearing, the Bank of England has announced that interest rates will remain on hold. The base rate's been at an all-time low of 0.5% since March 2009. The Monetary Policy Committee, which sets the rate, voted 8-1 in favour of no change. Well, our business correspondent Victoria Fritz is at the Bank of England for us with more on this. Hello, Victoria.
Hi, hello Carol. Yes, that's right. So it is now the 77th month in a row that rates have remained on hold at 0.5%. They also decided not to add any extra funding to the quantitative easing programme, so that is still on hold at £375 billion. Now, what is interesting is the detail here. For the first time this year, we've seen a split in the Monetary Policy Committee in their voting, and it was yet again Ian McCafferty who decided to be the dissenter when it comes to rates. He actually voted for a rise. He voted for a rise of 0.25%, but the other 8 on the committee voted no. And some of the big issues behind that, of course, the ongoing turmoil in Greece, what's going on in China and the slowdown there, and perhaps the fact that the UK economic recovery, although it's still going on, is a little bit more lumpy than some people would like. Let's speak now to the Associate Director of Fidelity Worldwide Investments. That's Micah Curry. Thank you very much for joining me here. Micah, an 8-1 split. We were expecting perhaps even more of a split from the Monetary Policy Committee. What's your reaction?
That's right. Expectations were that 2, even 3 members of the Monetary Policy Committee might vote in favour of raising interest rates soon, but we only had 1 voting in favour of that. So what does that tell us? That tells us that the Bank of England is still very cautious on the future path of interest rates. And there's a lot of information out today, so I think it's important to focus on Mark Carney, what he said in the press conference, and also on the inflation report, because that is the quarterly health check on the state of the economy.
What does all of this mean for the expectation of raising rates? I mean, does this mean that it kicks it further out into the long grass?
I think there is a very small chance that rates will rise this year. It's been pushed out further. Most economists expect February next year. When rates do rise, as Mark Carney said in the press conference, the rise will be gradual and limited. He stressed that we shouldn't focus on when rates rise, but focus on how they rise, and any increase is going to be really incremental and slow.
And when they do rise, I mean, we're not looking at a long-term picture. I mean, historically, the average was something like 5% when it comes to interest rates. We're not going to see anything like that in 2 or 3 years' time, are we?
No, we're not. The new normal will be around, or what the Bank of England is aiming for, is 2.5%. Now, that's half of the historical average. And that has massive implications for savers, for investors, and also for retirees. Because remember, they rely on interest from income investments, from cash savings accounts to supplement their pension savings. Of course, the winners are borrowers. Those are mortgages, because interest rates will remain low for longer. That means it's easier to pay back the debt.
So no relief for some time to come when it comes to savers. But let's talk now about the economic recovery. We saw his forecast when it comes to the economic growth picture here in Britain for this year rise a little bit to 2.8%. I mean, what should we make of that? Is the recovery on a stronger footing?
The recovery is on course, and there's a lot of positive news, but as Mark Carney said in the press conference earlier, there's some key indicators, some key data that they're keeping an eye on, and that is productivity, wage growth, core inflation, so inflation with fuel and food prices stripped out, and of course what's going on in the international economy. There's still a lot of concerns around Greece, around China, and the Bank of England will be keeping a close eye on that.
Micah Curry, thank you very much. Yeah, so you heard it there. There are lots of things still going on at the moment. There are pressures that the Bank of England can do nothing about. Things like the strengthening of the sterling has actually gone up 3.5% since the last quarterly inflation report in May. So strengthening sterling is a real issue for manufacturers. It's something that they pointed out time and time and again, and it's making the recovery for them increasingly difficult. The BCC today, for example, was saying that manufacturing is still more than 5% below where it was in the first quarter of 2008 before the financial crisis. So there still looks like there's a bit of a way to go for the economic recovery.
OK, Victoria, many thanks for the latest from the Bank of England.